Have you ever wondered why a stock goes up or down every single day? Why is Apple's stock $180, while another company's is just $10 or even less? Here's the truth. Stock prices aren't random. There's a powerful system behind how they reset, and understanding it is the first step to becoming a smarter investor. Stick around, because by the end of this video, you'll know exactly how stock prices are determined, and how you can use that knowledge to make money in the market. Part 1. The basics. Let's start simple. A stock is basically a small piece of ownership in a company. When you buy a share, you own a fraction of that business. Now, the price of that share, that's determined in one place, the stock market. Think of the market as an auction. There are buyers and sellers. Buyers place bids for what they're willing to pay, and sellers set prices for what they're willing to accept. When the two agree, that S, where a transaction happens, and that S, the current stock price. Part 2. Supply and demand. So, what really moves prices? It's the same rule that controls everything from real estate to sneakers: supply and demand. If more people want to buy a stock, demand is high, then sell it. Supply is low, the price goes up. But if more people are trying to sell, and no one's buying, the price goes down. It's that simple. However, the reason people want to buy or sell is what makes it interesting. Investors buy when they think the company's future looks bright: more profits, better products, higher growth. They sell when they think the company's headed in the wrong direction: poor earnings, bad leadership, or negative news. Part 3. The role of market perception. Here's where psychology kicks in. Stock prices are not just about facts, they're also about feelings. Even if a company's doing fine, if investors feel nervous about the economy, inflation, or interest rates, prices can fall. On the other hand, when optimism is high, prices can rise even when profits don't. This is what we call market sentiment, and it plays a massive role in price movements. Remember, the stock market, isn't a math problem, it's a voting machine in the short term and a weighing machine in the long term, meaning, day to day, emotions drive prices. But over time, real business results determine value. Part 4. Earnings and fundamentals. Okay, let's talk fundamentals, the real numbers. Every company has revenue, money it makes, and profit money it keeps. When profits grow consistently, investors are willing to pay more per share. That's why stocks of profitable companies like Apple or Microsoft trade at premium prices. Analysts also use key metrics like P/E ratio, price to earnings, to compare whether a stock is cheap or expensive relative to its earnings. If a company earns $5 per share, and the stock trades at $100, the P/E ratio is 20. That means investors are willing to pay $20 for every $1 the company earns. The higher the ratio, the more growth investors expect in the future. Part 5. Institutional investors and algorithms. Here's something most beginners don't realize. A huge part of price movement comes from big money players like hedge funds, mutual funds, and large institutions. These investors can buy or sell millions of shares in seconds. And now, with modern technology, AI algorithms and trading bots execute trades automatically based on data and news faster than any human could. This means stock prices react almost instantly to headlines, earnings reports, or even rumors. It's why you'll see sudden spikes or drops within minutes of news breaking. Part 6. Market manipulation and news impact. Voiceover. Of course, not every price move reflects reality. Sometimes, the market overreacts. A single tweet, a viral rumor, or emotional panic can cause a sell-off even if nothing's changed fundamentally. That's why successful investors don't just watch price charts, they look at value. They ask, is this stock worth more or less than what people think right now? That's how people like Warren Buffett make billions, by buying when prices drop below real value, and holding long-term. Part 7. The takeaway. So, to sum it up, stock prices are set by the constant tug-of-war between buyers and sellers, driven by three forces: supply and demand, market perception, company performance. Once you understand that, you can stop guessing and start thinking like an investor. Don't worry about predicting short-term moves. Focus on buying good companies at fair prices and holding for the long run. That's how real wealth is built in the stock market. If you found this helpful, make sure to hit like, subscribe, and turn on notifications so you don't miss our next video on how to value stocks like a pro. Comment below. What stock are you watching right now? Let's build your financial clarity, one video at a time. Finance Clarity, making money make sense.